This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week.
When we talk about the two halves of that K, the bottom half, I think, are really struggling. The jobs market, if it starts weakening, can actually weaken quite quickly. Look at this year. I think the Fed have held rates higher for longer. They didn't know what level of tariffs were going to be and how that would impact prices. But I think the Fed have held rates higher for longer than they would otherwise have done. And my worry is that means that the damage they're doing to the bottom half of the economy is there, and it's just masked by the top half.
As many do in December, we are in review and look-ahead mode, considering what drove the 12 months coming to a close while thinking about how markets might move in the next year. Like I said last week, it's not that a new year necessarily changes anything regarding the course of markets, but the turn in the calendar is at least a convenient line of demarcation, and if performance is still going to be judged based on calendar year returns, I guess we have to play ball. Last week, we heard from 12 members of the macro strategy team, each with their top idea for 2026. Next week, most of those same voices will be back on the podcast for our last episode of the year with their top book and media recommendations to consume during the Christmas time period. Always one of our best episodes. But this week, focus shifts to our trading desk. Peter Vincent is a regular on Street Signals. He sits about 4 rows of desks away from me, and he runs the European trading business for State Street Markets. He's always got something to say, and thankfully, we get the benefit of that yet again this week with a wide-ranging discussion on what to expect in rate and FX markets in 2026.
How's it going?
Hey. How you doing?
Always busy, plenty going on.
Yes.
Looking at the calendar, 2 weeks to crawl over the line.
Exactly. That's just it. I wrote the Developed Market Weekly this week. 8 central bank meetings in 8 days, and then it's done.
And we think we know what they're going to all do. So
well, we think that.
Yeah.
We'll see. We'll see. We are actually recording this just before the Fed, so that's slightly inconvenient. What can you do?
Well, I can tell you they're going to cut. So
that's I think that's probably right. Right. We'll probably have to pull this podcast if they don't.
Yes.
Well, yes, we are doing kind of a year ahead, but also a look back, I think, with one of our favorite guests, Peter Vincent from our trading desk. Pete, thank you so much for doing it as always.
My pleasure.
Good. Well, let's look back. Let's start with 2025 and talk about the year you had, the year markets had, and I'm curious to hear specifically what went well for you this year.
What went well? I mean, there's been a lot. There's been a lot to navigate this year, that's for sure. I would say, on reflection, what's gone well is probably risk management. Because I look back at the year and we've had some huge moves in individual currencies and stocks and rates. And as a market maker, there's always a good chance you're on the wrong side of some of those, whether it's intentional or unintentional. But we've got through them all. As you know, we've been on the wrong side of a few of them. We've been on the right side of a few, which obviously helps as well. Particularly Liberation Day, which was enormous moves. You know, the fact we've got to the end of the year unscathed is a good thing. And I just think if you're running a market making business, you know, the thing that keeps you up at night is those positions, inventory, those, and the unknowns. And we've had plenty of them. And then, you know, I was just reviewing the year. It's definitely been a year of two halves. You know, we started at the start of the year with a dollar on its highs, basically, and not much expected on rates. In the first quarter, we priced in a lot of cuts. We had a 10% move up in dollar Turkey in one morning, which was, you know, a lot of market participants had been running that as a carry trade, so us included. So that was a challenge. And then we obviously had Liberation Day. I won't go through that. I think we all know what happened there.
We all know.
Other things, knock-ons from that. You know, we had a circa 10% move in dollar Taiwan lower as the market worried that, you know, Asia would have to change its FX strategy on the back of negotiating the tariffs. And then let's not forget we had a small war between Israel and Iran in June almost seems to have dropped off the radar, which didn't cause a big market eruption, but was certainly interesting to trade around. We got to June and it all stopped.
Yeah.
And the second half of the year has been very quiet. I was just looking at some charts. Deck 25 Sofras are 5 ticks away from where they were on the 31st of June. So we've had a year of two halves, and it's been full of surprises. I mean, after Trump's first term, one thing you learned was to expect volatility, and so I was kind of prepared for that. I've probably perhaps been surprised how quiet the second half has been. But as we go into year end, it's getting a bit more interesting again. Possible changes to who's going to replace Powell, and then the fiscal stuff starting to rear its head again. So there's plenty going on to keep thinking about as we go into 2026.
I wanted to leapfrog to a question I had for you later, but you brought it up in terms of managing risk. I mean, the thing that I guess I learned or relearned this year was from a book by Benoit Mandelbrot. Somewhat theoretical, but he has these principles, one of which is timing matters. You get your big gains and losses in small concentrations of time. Kind of to your point about things like Liberation Day, the dollar Turkey move, the dollar Taiwan move, and thinking about how you risk managed that. And specifically, has your risk management process changed as a result of that? Or is it going to have to adapt again? Or is this a year where you just take that and move forward and it has changed the way you managed your book?
I mean, I've had a very set process for a very long time. Traders and investment managers either think in P&L or in basis points, and I try and turn it into basis points. And I basically say, how much am I trying to make a year, and how much capital do I need to employ to do that? So let's just say we take a number and we say, okay, let's say you're trying to make $10 million a year. I'd say, okay, a successful trader, stroke hedge fund guy, 10% return would be a good return. So I kind of say I'm starting with a pot of capital of 100 million, and then I divide my trades up according to that. And if I'm all in on something, and I think there's good risk reward, when I say that, I mean limited downside, I might be 100% invested in that. If it's something that could go either way, I might only have, a core position might be 20%, 25%. And I've always stuck with that. I don't extrapolate it for the room, but it's kind of how I look at the trader's risks. What you want to do is, you said you want to have good risk. You want to have good sized positions when you think the risk reward is in your favor. So it's kind of using a framework like that, and that stood me in such good stead that I don't deviate from that too much. What I have to do is, one thing I try and I need to improve on is ramping that up when I really do think we are at some extremes. And a couple of examples this year. In June, some people started saying the Fed might hike again, and I just could not see that. That was very good risk reward at that point to kind of go all in on being received rates. And you get times where there's good risk reward. Like this morning, for instance, we've had quite a big move in Aussie rates, and the market's pricing in 2 hikes for next year. I mean, they've only cut 3 times already. To say they're going to remove 2/3 of that when inflation is nowhere like it was in 22, 23, I find that a bit of a struggle. So, you sometimes get some good opportunities where you might have some relative trades. So it's really sizing your positions and just realizing what can go wrong. If Aussie rates are to go up by more than 0.5%, I would imagine rates are going up everywhere, and other curves could be moving by more. So there's some relative plays there and things like that. So yeah, I'll stick to my process, and I'm always trying to refine it and make it better.
Well, let's think about maybe things that were more negative influences. What went wrong for you this year? What didn't you get quite right?
I mean, the biggest thing's probably been the yen. It's very hard to break a 25 or 30-year habit of trading yen on either US rates or if you think stocks are going to come off. It's obviously been a carry funder for a long time, and that relationship is, particularly since Takichi took charge of the LDP, that to me is now gone. If we get into trouble in markets again, the fiscal profile in Japan is such with the demographics that it's probably not going to be a safe haven. And the problem I've got with the yen now is I struggle to, like we've got the bodge coming up, right? Even if they hike it, they're still going to be running negative real interest rates. It's just hard to see anything domestically that's going to strengthen the yen. It's only going to be a calamity in markets elsewhere that causes a position squeeze if people are short of it and using it as a funder. Those long-held biases are very hard to let go of, and particularly when you've got politics changing, being open-minded and not being dogged is one thing, and probably dollar yen's been one thing that I've probably stuck to and clung to, but I have given up trying to buy the yen as a risk off. I think there's better crosses you can use and just, stay away from the yen.
When that happens on the strategy team, that means it is probably the best time to buy the yen, just so you know.
It probably does. I mean, when everyone gives up.
Yeah.
But I do think now you've seen the trading pattern change since she took charge of leadership, and it's traded very much like sterling. So you look at how sterling traded into the budget. The minute the market was worried about Labour not acting responsibly fiscally, you saw sterling weaken, and then the budget, was actually the OBR wasn't as bad, and they were responsible, and sterling's recovered. And I think we're going to get that sort of dynamic with the yen. That if they propose anything that the market doesn't like, you'll very quickly see the yen weaken, which is rather ironic that populist leaders, their policies tend to be quite unpopular. It's inflation that's unpopular, and all these populist policies tend to lead to inflation at the moment.
Well, this is a really relevant question. I think a really nice way to think about the coming year now. And we're certainly going to talk a lot about the US. And as you mentioned before, fiscal policy in the US is coming back potentially into focus. We shall see. But of course, there are midterm elections to consider. There's all these other kind of known risks for the coming year, whether it's, Trump is not as popular a president as he was a year ago. He doesn't necessarily have as sweeping a mandate, but he still is in a position to make significant changes. But of course, markets have adapted to that, whether it's this year kind of recognizing the taco trade, as it were, after Liberation Day, or maybe shrugging off some of these worries about Fed independence. But before we get into any of that, I wanted to see if you could level set and give your assessment of where you see the consensus. What is the kind of expectation for all of these things? And what does that mean for US rates, the dollar, EMFX, things like that?
Yeah, and I think it's always very important when you're trading to work out what the consensus is. A lot of the time it's obvious, but it isn't always obvious. But I think at the moment the consensus is that we have a K-shaped economy in the States. We have the top half doing well, with asset prices still performing incredibly strongly, with the bottom half struggling. And the key thing for next year is working out the interplay between those two halves in the economy. I think we've got a good idea what will happen with the Fed. And the debt situation isn't going to get any better, and it's how that plays out. There's probably consensus that curve steepen, and you've seen that in the last week, particularly as Hassett's odds have shortened for the Fed chair. Investors would want a higher return for holding bonds. If the risk of bonds goes up, you're going to need a higher yield to compensate for that, and I think you've seen that in the last 10 days. I think the consensus trade that the curve steepens is fine. I guess what we don't know is whether it bull steepens or bear steepens. And I think, at the moment, that seems to be the big debate out there. Lots of people I read who I respect immensely are calling for 10-year yields up at sort of 4.5, 4.75. And then, other people I respect a lot see lower front end yields and we get the steepening, but bull steepening led at the front end of the curve. So the other point about the K-shaped economy is nobody really expects a recession at the moment. Although we have public balance sheet, in a pretty bad state, private and corporate balance sheets are pretty good. Next year, we're going to get a 1% fiscal boost from the One Big Beautiful Bill Act. We've also got CapEx spend from AI, which is probably going to add 0.5% to GDP. So nobody's really forecasting a recession at the moment. And you can see that in stocks. So I think, another surprise would be if something caused a recession.
Do you see any risks to that? I mean, we got JOLTS data this morning that suggests the labor market is not in a great spot, but also not a disaster. We've missed a lot of data, of course, but the picture from the labor market is one of standstill as opposed to reacceleration or recession. I mean, do you take issue or have any challenges to that kind of prevailing consensus view that the US kind of muddles along and fiscal stimulus helps? It's difficult to have a recession when fiscal policy is this expansionary. But what could derail that? Where does it go awry?
I haven't got a problem with that. And, and I think Fed rate cuts, add those in as well, getting back to neutral supports that view. I'm just cognizant of the risk of what might change that. And when we talk about the two halves of that K, the bottom half, I think are really struggling. And the jobs market, if it starts weakening, can actually weaken quite quickly. So I don't think we're out the woods yet. And although we can cut rates in response to a slowing economy, we could get that slowing at the start of next year. I mean, look at this year. I think the Fed have, after the debacle with transitory, they've held rates higher for longer. They didn't know how the tariffs were going to, the level we were going to have. We've settled on what was probably consensus at the start, but with a scare in between. They didn't know what level the tariffs were going to be and how that would impact prices. For me, at the moment, it's doing exactly as you would probably expect. We've got a bump in prices and they should come off. But I think the Fed have held rates higher for longer than they would otherwise have done. And my worry is that that means that the damage they're doing to the bottom half of the economy is there, and it's just masked by the top half. So I worry that there's a seeping deterioration in the majority of the economy. It would only take a couple of bad jobs numbers, and I think we had a lot of tailwinds up until the start of this year supporting the jobs market. We could have a lot of headwinds going forward. The size of the government coming off, some of the seasonal adjustments, birth, death models, all these sort of things could drag the headline numbers, payroll number down. So that's one thing I worry about. And then the second thing is the top half of the K. I'm a little bit of a value trader, investor by heart, and I look at the AI stuff, and I'm not an expert on AI, but I have to try and evaluate what that might do to markets. And I see two potential issues there. One is company specific, and the other is sector specific. So just on the company side, if you take a company like Oracle, they've got 100 yards of debt, and they're forecast to end up with 300 yards of debt. That is the same size debts as South Africa. So some of these companies are acting as small countries, and so they could become systemic for the markets if they got into trouble. OpenAI have got, I read this morning, 1.4 trillion in compute commitments. To make the maths work, they need to get revenues to 500 billion, which is the same as Google, and they're at 20 billion. I'm not saying they're not going to get there, but if someone like OpenAI got into trouble, I don't know what issues that could cause for the broader market. And then just sector specific with the valuations and energy constraints and overbuild and excessive supply. I worry we could, the top half of the K could collapse quite quickly. And so I understand the consensus, and I can see that playing out. But I'm just alert to some of these risks on the two halves of the economy and how they might pan out differently to what's expected.
Yeah, it brings up all sorts of questions as far as what you think about the Fed, how far they go. You mentioned almost implicitly that Kevin Hassett, his commentary obviously takes on more meaning given he is the front runner to get the job. Should we assume he has the job, or why not wait for Bessent, see if he finally agrees? I mean, that's part one. Do you think he ultimately does get the job? But part two is, does that introduce to you independence concerns? This is something that is a kind of known unknown, and so it's not exactly kind of original for us to talk about it, but it's also maybe speaking to wanting to run the economy hot, and that steepening you talked about that might not necessarily be dollar negative if it's bear steepening. But just to start back with the original question, where do you see the makeup of the Fed in 6 to 12 months time, and how does that correlate to the policies of the administration making those appointments?
I think Hassett will get the job. Trump wants someone in there that is, will do his bidding and he's of the same type of view as him. How does it threaten independence? I don't think it totally. It's a committee at the end of the day. It's not a dictatorship. We could have quite a split Fed next year, but I still think they have to meet and decide monetary policy based on what they see, whether it's slowing growth or rising inflation or whatever they're faced. And I think they will do that. So I don't worry that they're going to suddenly lose independence and that makes the dollar collapse. I worry more about the direction of travel fiscally and, like you say, run the economy hot. Does that panic markets at some point? These are difficult questions to answer. If US debt GDP at 125% is not in the danger zone yet. And even if you're running a 6% deficit and you've got nominal GDP at 4%, it could be 5. I could be retired by the time this is an issue. But I think what we talked about earlier with the yen and with sterling, it's the direction of travel, and it will just be a little nudge at a time. So if Hassett gets it, and then it's clear that they're running policy softer than they should, and the dollar starts to weaken, and maybe we get a little bit of imported inflation and that sort of thing. I think it's going to be more baby steps rather than one big blow up. Like you said, the midterms, how desperate does Trump get? I think he's been quite quiet the last 3 months, really. So, is there something out there that he could do that could change everything? Maybe, but you've seen how quickly markets can rein in policy as well. I think it's more of a sliding scale that I'm worried about. And I think when you look across markets, whether it's the steepening we just talked about or the gold price, markets are preparing for this and trying to position for it. People are already recommending commodities for 26 and stuff like this. So I don't think any of this is going to be a big surprise. It's just how it plays out will be the interesting thing to watch.
Yeah, I mean, going back to consensus positioning, I mean, one of the things we've talked about for a long time now in our indicators is a dollar underweight that has now been built to one of the largest in recent years. Part of the thinking is that in future quarters, you have owners of US assets becoming more likely to hedge. We've talked about this, I think, in probably every other episode we've done the last 6 months as our equity hedge ratio indicator. This notion that hedging of US assets goes up as a big driver of dollar weakness over the long run. And I think that's become the consensus outlook. But I'm curious if, a lot of what you've said, you can almost interpret if there is pushback from the market on Fed independence concerns, that might restrict the Fed a little bit more in their activity in easing policy. Do you have a dollar bias that comes out of all of these kind of cross currents you've mentioned for the coming year?
Yeah, it's lower. And I'm not I was a dollar bull for about 5 years. So, as we just said, the Fed have kept rates pretty high while other central banks have eased. I think the gaps on some of these yields are about as wide as they're going to be at the moment. So I see that closing. And then just going back, we've talked about Fed independence, but actually for inflation, I actually think you might see the opposite of what people are worried about next year. I think, as I said, we're seeing this inflation hump because of the tariffs. Once that starts dropping out the base effects, we actually end up with inflation back at 2%. It's just that inflation's been this high for this long. I think some people just think that's the new normal, and I'm not sure it is. I think once we get, into 26, the tariffs are a tax, monetary policy's been kept tighter than it would have done, as I said. The economy's slowing down. I don't see a big problem with inflation. So it may not be that policy causes inflation. People may just be worried about policy full stop, not that it's actually causing inflation.
Yeah. Policy responding to inflation, actually getting back towards target the way it kind of traditionally would.
Yes. So next year could be a year of two halves. But I think we've got to get through this weakness first. I can't think about rates going up in the States until they've come lower first. I need to see them down to 3% before I think about them going up, if I'm honest.
Well, that begs the question then of the rest of the world. And I was putting a chart together for our weekly today, and it's going to be published by the time this goes out. So I'll throw it in the show notes that I now probably have to write because I just talked about it. But it shows US rates, which 1 year forward are projected to fall, I don't know, about 75 basis points, which includes the cut that's going to come at the meeting on Wednesday this week. But then also looking at all the other G10 central banks except the Fed and the average move expected for the next year in those central banks, which is now it's up to zero, which means the easing cycles have been taken out. You still within that have the Bank of England expected to ease, the ECB, the S&B expected to do nothing. But you now have, and you alluded to this before, big repricings in the front end of Australia, Canada, Japan, those three, especially the last couple of weeks. You now have proper divergence of rates away from the US. And I'm just curious what you think about the gap between the rest of the G10 and the US and whether that can continue to widen, not so much from the perspective of lower US rates, we know that's likely to happen, but from everywhere else. Can we price more aggressive hiking cycles absent? You mentioned Australia already, so maybe that's a no. But I'm thinking Canada, maybe Europe gets in here, where you had Isabel Schnabel yesterday talking about the next move being likely a hike and being okay with that. Do you see the other side of it, adding more rate support elsewhere to weaken the dollar?
Yes, I do. And particularly, so if you take the ECB and you take Canada, you've got fiscal support coming in both those regions, and they've already eased rates. So price stats talks about US inflation being high, but we're also seeing some inflationary pressures in some of those other countries as well. So I think the easing's done. Quite unusual to be in this situation where some central banks have eased and finished, and the Fed's still potentially got 75 basis points to go. I can't quite remember a situation where we've had that divergence of policy. So I think that should lead to some volatility next year. And for me, as I said, it will be relative trades. And I think there's some good risk reward trades where you might look back and go, well, that was quite obvious. Where some rates can go up and you've got the fiscal support, whereas others could still come off quite a long way. It's just picking your levels really, and trying to be cognizant of those risks.
So overall, then, the picture for next year looks to be one of dollar weakness, maybe a little bit of higher volatility, which in and of itself speaks to a correlation that has really changed this year and has potential to change next year, in that the dollar is not really much of a safe haven when that's the case, when that relationship breaks down, much as it wasn't during Liberation Day. Where do you look to for safety within FX? We've kind of crossed the dollar off the list. You crossed the yen off the list. The Swiss franc, even at a time, it has not been a great safe haven, in that equity markets have done well and it's one of the better performing currencies this year. What's the sort of funding currency that then becomes maybe a source of safety in periods of volatility for you?
Yeah, we're kind of back to this least dirty shirt theory,
Yeah.
aren't we? That people were talking about a few years ago. It's a difficult one because if you go back and you look at fiscal sustainability, places like Australia are pretty well placed. But it's always been a risk on and off currency in terms of, it's a commodity producer, and it tends to sell off. So it's hard to find those. I think the euro is probably the best safe haven. You're not going to get any independence fears out of the ECB. You've got a fiscal dynamic which isn't as bad, in aggregate. Obviously, France has tapped out, but the periphery has done amazingly well. Italy's doing a great job of sorting itself out. So I think the euro is probably that safe haven. And if you want to, if you get a situation where you need to sell risk in currencies, it will be some of the crosses that you look towards. Because as we've seen, like, the dollar has been up and down a lot this year, and it's hard because even if you get issues coming out of the States, the dollar often rallies. Although I've got a bias for a lower dollar, it's against something generally like the euro, which I think could actually be, quite a big beneficiary if we get a US slowdown while the ECB are thinking about increasing rates. Could get clear divergence in monetary policy, which helps the euro next year.
Does the weaker dollar continue to help emerging market currencies? In particularly, I'm thinking of EM carry, which has been a big story this year, remains a somewhat position story, I think. Well, things like Brazil have maybe been shaken out a little bit, but I'm wondering how that then squares up with maybe a year of higher volatility. It can't get a lot lower than, as you mentioned, the last 6 months we've seen. And how positioned do you think emerging market currencies are? And we haven't talked about sterling, by the way, so feel free to throw that in as an emerging market currency, given it looks like one all the time. But curious for a final take on that side of it as well.
Asian currencies seem particularly weak at the moment. Obviously driven by the yen, I guess, but Korea is particularly weak. So it depends what EM currency we're talking about, I guess. Generally, I've been a fan of emerging markets, being invested in emerging markets. If you guess a lower dollar, it should benefit those countries. If they intervene, support their currencies, it tends to increase the money supply and it helps their growth dynamic. And if some of the consensus views prevail and we get high commodities, that tends to help emerging markets as well. So absent of the wheels coming off the US economy, which causes a big risk-off move, emerging markets should really continue to do quite well. Sterling, I put in the same camp as yen at the moment. We're right up against it, I think, fiscally. The Labour Party, it's a split party, and if the left of the party were to gain more control, I think the market wouldn't like that, and they'd worry about their sustainability. So I think the UK is a little bit stuck. We're kind of getting austerity forced on us. From what I've just said about Europe and higher rates, and we're going down an austerity path, I think Europe, the euro sterling should be going higher next year over time. But I think there's already a discount in sterling, and that's why it's recovered a bit post the budget. But I don't know if you can price that discount out completely, because our fiscal situation isn't going to miraculously solve itself. There's a bit of a brain drain going on, if you like. Our industry are losing a lot of people to the Middle East for tax purposes, and these people are big taxpayers in the UK, and I worry that we're undermining our tax base. And it's one of those things you don't notice on a daily, weekly basis, but at some point you turn around and you realise that your economy's been hollowed out a little bit. So look, I worry about that for sterling, but that's maybe a bigger picture philosophical thing. I struggle to see how we're going to turn it around here at the moment. That's my problem.
And that might be a view for the 2027 year ahead. But for the 2026 piece, I think, look, last week we had 12 ideas from the strategy team. I think we've gotten at least that many from you, Pete, from the trading desk. So probably a good place to call it there as we continue our series of year-end episodes. But as always, very much appreciate you joining, and always great to hear your thoughts.
Thanks, Tim. Let's do it all again next year.
And we will. Thanks so much, Pete.
Cheers. Bye-bye.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time.